What's a country without a properly functioning stock market? We all know how important the stock market helps boost the economy of a country and how it can affect the economy when it starts to fluctuate. One of the unpredictable circumstances hit the market last year as there was a global health crisis. In today's video, we're going to show you stocks that did the worst during the global health crisis. Sundial Growers down 84.3%. Sundial Growers happen to be one of the worst performers on the stock market in the past year. Sundial Growers is a marijuana producer. It's one of the stocks that's priced at penny stock levels. It currently trades for under 50 cents per share, but the stock still has a market valuation above $300 million. The company started the year running low on cash just a few months after its IPO and was in violation of its debt promises. Then things went further down the drain. Pandemic hit, and it had to resort to sales of assets to raise money. While the company has paid off all of its debt, it has also heavily diluted shareholders in the process. It may eventually need to effect a reverse stock split to keep its NASDAQ listing. NextCure, down 80.9%. NextCure is a biotech stock that also didn't have a good 2020, like at all. The company kicked off the year with a Securities and Exchange Commission filing that revealed Eli Lilly had ended research and development collaboration, and 6 months later, it was revealed that they were ending its trial for non-small cell lung cancer and ovarian cancer for its NC318 immunomedicine therapy based on the response data and enrollment. The NextCure's chief medical officer resigned. Shares of the biotech that had traded as high as $70 per share now fluctuate around $10. PBF Energy down 78.1%. PBF Energy, which is an oil and gas refiner, also suffered a great loss during the global health crisis. The oil and gas refinery was weakened when oil prices decreased below $20 a barrel, which led the company to suspend its dividend and declare it was selling more than $500 million worth of its assets to raise cash to keep the company afloat. Inasmuch as refiners tend not to show oil prices due to the fact that their businesses operate more on the demand for energy by the populace, even low oil prices couldn't revive the travel and tourism industry. Some politicians tried to effectively cancel Christmas by recommending people not visit their extended family for the holidays, but it didn't work as much as they wanted it to. COVID-19 vaccines and some measures out in place definitely give rise to some hope for recovery sooner rather than later. But unfortunately, PBF Energy stock continues to fluctuate around $7 per share. Telluride down 81.3%. Upstarts like Telluride, which wants to break into the liquefied natural gas market by developing its own export terminals and pipeline infrastructure to support it, have been denied access due to the decline in pricing that has impacted the industry. Although the U.S. has become a world leader in liquefied natural gas exports thanks to Cheniere Energy, while it has the financial wherewithal to ride out this storm, at least for a while longer, Telluride did also just lose its CEO. She was, however, replaced by an industry pro from Sempra Energy, which could be why Telluride's stock has doubled from its recent lows. Yet, considering how far its stock is still below where it started in 2020, it shows how low it had fallen. Tricida down 79.5%. Drug manufacturer Tricida also shows support for its stock crumble after the FDA said its application for acceptance into the accelerated approval program for Vivimur, its therapy for chronic kidney disease, was flawed. While the FDA didn't expatiate on the deficiencies, Vivimur is Tricida's only drug in clinical stage development, so the denial is crippling its ability to advance due to the fall in its stock. Invesco Mortgage Capital down 79.9%. Real estate investment trust Invesco Mortgage Capital was an early casualty of the pandemic, suffering a near-death experience earlier this year as a liquidity crisis in mortgage-backed securities led to sell securities, slash its dividend, and vow to only invest in agency loans. Invesco Mortgage Capital is one of the companies that had its worst due to the global health crisis. Invesco is a mortgage REIT, which means it invests in mortgage debt rather than the real estate itself, as traditional REITs do. Although most of its mortgage-backed securities were guaranteed by the government, agency debt, about a quarter was in non-agency loans. That segment's collapse caused a cascading effect that nearly took Invesco down with it. Hopefully, the company will bounce back stronger soon enough. Amarin down 76.6%. Irish biotech Amarin was pummeled back back in March after a trial judge in Nevada invalidated several of the patents surrounding Vascepa, a modified fish oil treatment that lowers triglycerides. The judge called the company's intellectual property obvious and nullified the patent, virtually wiping out Amarin's business in the U.S. It regained a little of the ground it lost over the summer as it appealed the ruling, but got slammed again in September when it lost the case. Its stock hovers around now at around $5 per share. Intercept Pharmaceuticals down 78.4%. Another biotech crushed this year was Intercept Pharmaceutical. It was run down when the Food and Drug Administration denied approval of its obeticoic acid (OCA) treatment for non-alcoholic steatohepatitis, NASH, or inflammation of and damage to the liver caused by a buildup of fat. While the FDA did extend its olive branch to Intercept to try again with more data, there's a lot of competition for treating NASH, and doctors typically just recommend patients lose weight to reduce body fat. Washington Prime Group down 77.7%. Washington Prime Group is another REIT wrecked by the pandemic. But unlike Invesco, Washington Prime operates shopping malls, which became ghost towns when retailers were forced to close. There was no other option because the stocks couldn't be revived. Malls were already suffering from declining traffic, and the lockdown sealed the fate of some. Both CBL and Associates and Pennsylvania REIT ended up in bankruptcy. Washington Prime's major issue is that many of its malls are not in top-tier areas and could see tenants abandon its properties if traffic doesn't bounce back. Occidental Petroleum Corporation down 57.7%. Investors will notice a common theme among these worst-performing stocks. Travel restrictions and economic shutdowns crushed oil industry demand and oil stocks in 2020, and Occidental was the hardest hit in the group. Stock dropped 57.7% in 2020, more than any other S&P 500 stock. Urban Outfitters down 3%. Urban Outfitters stock rounds out the list with a 3% decline. Like other clothing companies, it struggled in an environment where people just didn't need to refresh their wardrobes as often, and it struggled to compensate for store closures with online sales. That said, earnings have recovered in recent quarters, leading some analysts to predict that the worst is over. Carnival Corp, which is a travel and leisure industry, has been hit nearly as hard as the oil industry in 2020 due to the global health crisis. Carnival's cruises have been shut down completely for most of 2020 to prevent the spread of the disease, and will likely remain shut down for at least a couple of months in 2021 as well. Monroe down 34%. Monroe stock was the worst performer of the group, falling 34%. Like some of its peers in auto parts and services, Advance Auto Parts and AutoZone are among the 10 worst performers as well. O'Reilly Automotive was 11th. Monroe was hurt by a stay-at-home nature of the COVID-19 pandemic. People didn't need to drive as much for work, school, socializing, or entertainment. That cut into their need for car maintenance and repair. Walgreens Boots Alliance stock dropped 32%, making it the second worst retailer. The company took a hit as COVID-19 fears led many people to get their prescriptions online, meaning they weren't coming in to shop in the rest of the store when they had to refill their medication. The worries about this trend intensified when Amazon.com said it would get into the pharmacy business. Walgreens UK business has also been struggling. Ralph Lauren down 13%. Ralph Lauren stock fell 13%. The pandemic means that people need fewer clothes, especially the fancy varieties that Ralph Lauren is known for. That hurt sales and led to losses for the clothing company, although some analysts argue that it's gotten too cheap. CVS Health down 9%. CVS stock slid 9% and suffered from the same trends. Fewer in-store shoppers, fear of competition from Amazon that weighed on pure Walgreens. That said, Barron's noted that markets may be overestimating the Amazon threat for both stocks, and CVS recently named a new CEO. Do you think some of these companies that suffered major losses in their stock market will be able to still rise? What do you think these companies can do to get their stocks back up? Let us know in the comments section down below. Don't forget to give this video a thumbs up, subscribe to this channel, and turn on post notifications for this channel. We have loads of exciting content for you.